Very good afternoon to all. So we'll move ahead to our last session of the day of funding demystified event. And when the founder approaches an investor for the funds, impactful, a pitch deck should be artistic and informative. Vikram Gupta. A quick introduction about Mr. Vikram. He is the founder and managing partner of IVCA Ventures, a USD 200 million venture capital fund that invests through the alumni ecosystem that has a portfolio of 30 companies. They believe in leveraging global alumni ecosystems to build technology-driven innovative companies. IVCAP invests in early to growth stage companies with highly scalable and innovative business models with the potential of becoming leaders and disruptors in their industries. Since its inception, they have been working with a sector agnostic approach with a special focus on deep tech, consumer tech, fintech, health tech, ed tech, SaaS, agri tech, and have a portfolio of 30 companies. Mr. Vikram has over 25 years of experience in private equity, business consulting, mergers and acquisitions, strategy and operations in healthcare and life sciences, education, consumer goods, and other industries. Without a further ado, a very warm welcome to you, sir. The session is over to you.
Thanks so much. I will really appreciate that. And I know that this is the last session of the day. So at the same time, I know that I think this session could also be exciting, especially for entrepreneurs who are kind of curious to know what should go into a pitch deck. And I think it's an important document to understand how to present that. So I think let me first of all tell you how I'm going to present this. I'm not going to make a formal PowerPoint presentation in this session. I would like to keep it interactive, and I think the idea here is that I know that people probably may not be able to come on the screen and ask questions, but I think the good news is that you can post your questions, and I will be happy to take up those questions as and when I'm able to. But please feel free to keep putting your questions while I'm speaking, because in the first about 20-25 minutes, I'm going to just give you my views of what it takes and what is required when you're actually looking at building a pitch deck, and why it is important to be very, very structured in your approach. So first of all, I think I'm assuming that majority of you here are early stage entrepreneurs, and you probably haven't even raised your first meaningful rounds of funding. What I mean by first meaningful round of funding is that, you know, if you've raised money from your own family, or, you know, maybe somebody who's very close to you, who doesn't necessarily need a pitch deck, that may be purely based on your relationship, and therefore, you know, the meaningful fundraise comes when you actually pitch yourself to somebody who's either an institutional investor or a formal angel investor who likes to understand, even if they're putting in small ticket, they would like to look at your formal pitch deck to take a final call, right? So please understand that there are few components of in my view an effective pitch deck which are important to understand. First of all, I think it's extremely important to understand what your objectives are. What are you trying to achieve with your pitch deck? You know, are you looking to raise funds in the near term? Are you just trying to build a network with the investors, or are you really trying to attract very specific set of investors for a, you know, with a very focused process and a structure around? So things, and it could be different in terms of how you approach building your pitch deck. Now, if you are looking to just network around, I think the structure of the pitch deck should look slightly different, and it should not sound like you're actually selling yourself to raise funds. In fact, my recommendation to most of the entrepreneurs is that um, when you're in the market networking with potential investors, not sounding as working towards a timeline to raise funds, it's much easier at that time to actually attract good investors. But when you're actually working against a timeline, then it becomes quite challenging to uh, attract the right investors, because typically the investors who are right for you may have very different process and timelines, etc. And then if you are hard pressed and stressed around time, you may end up partnering with maybe the investors who are not necessarily the investors that you really want. So always assign enough time from the time you actually start thinking of networking with investors to the time when you actually raise funds or want to raise funds. So start this process very early on and map your investors properly. So the first and the foremost thing is, just like you would want to attract customers to your business, you will have to do a segment analysis of your investors as well. So understand what are the segments of the investors out there in the market. The segmentation of the investors could be on various criteria or various dimensions rather. One dimension is the dimension of the size of the ticket that they invest. If you're looking to raise, let's say, 5 crores total, and you start going to an investor who doesn't invest less than $20 million in a single check, that's a waste of time to reach out to that investor. I mean, somebody might argue that, well, I have to anyways network with that investor, and you never know, they might put in 5 crores. It's not going to happen. But it doesn't harm to still network with that investor, because those investors will have relationships in the ecosystem. If you actually know them well, or if you get an introduction, you can always talk to them, get some guidance from them in terms of who you should reach out to raise that 5 crores. But don't expect that that $20 million investor is actually going to invest 5 crore in you. So first dimension of segmenting the investor is the ticket size that they look at. Second dimension is the sector that they would typically be focused on. So if you are in a infrastructure sector, as an example, a very hypothetical example, you can't approach a tech VC. The tech VC will never invest in the infrastructure company. If you are in a real estate business, very unlikely that you will have somebody who, as a tech VC, who would invest in it. If you're in a agri business or a sustainability business, let's put it like your impact business, where while profitability is important to you, but impact is first and foremost priority to you, then you will have obviously think of very different set of investors. So these dimensions of the sector and the impact is a very important one, because there are investors who like to get segmented based on that. The third dimension is the dimension that is important from your perspective, is where you have to ask this question to yourself: what kind of investor do you want? Do you want the investor to be adding a lot of value to you? Do they bring an ecosystem of support system? Or is this just a team of 2 people that has managed to raise 100 crores, and they'll write a 5 crore check to you, and they have written maybe 122 crore checks to another 100 companies, and you are one of the 100 companies in their portfolio? And if that is the case, you're not going to get enough attention from them. So don't expect that you're going to get anything beyond capital. So the third dimension from your perspective is the dimension of value that you get from the investor. And the fourth dimension, which is also important, is the geographical dimension, where certain investors may be very focused on certain geographies. Even if they're based in India, for example, and they may be focused in maybe metros, they may be just focused on Bangalore, Bombay, NCR region, and if you are based in Indore, or if you're based in somewhere in the Northeast, you don't know whether these investors might actually be interested to invest in those towns. So you have to look at that dimension of geographical dimension where they are actually investing and where they're likely to invest more. The fourth dimension is the fifth dimension is the dimension of global scale. It's more of a geographical dimension as well, but it's more to do with the network of the value they can bring through a larger. It's just not an India focus, but could be a global focus. And if your business has a global aspiration, then that becomes an important part to look at. And sixth one is more to do with the fund itself that you're looking at. What kind of experience they have, what kind of portfolio they have, can they bring value to you. So look at these six main dimensions. There could be other dimensions as well in terms of the seventh one could be the quality of people involved and individuals or the partners and things like those. But I'm just giving you highlights of the key dimensions that you would look for before selecting the kinds of investors that you want to go after. And there will be enough sources for you to understand what are the total number of investors available out there. There'll be enough information, public information out there, where if I were you as an entrepreneur, the first thing I would do is map out the entire list of investors, and then across these 6 or 7 dimensions, rate them and have some kind of a criteria to kind of say that, let me then sort the list based on the ones who actually really meet my criteria, and then decide how you prioritize reaching out to the investors. So it's a very scientific method, but it's worth it, and it's very, very useful in your overall fundraising planning process. So that's the first exercise I would do as an entrepreneur. The second thing I would want to do is, now that you understood that these are the top 20 investors that you're going to target, obviously your next question to yourself would be, how do you reach out to these people? Obviously, if you just write an email saying that, hey, I have this startup and I really want to come and pitch to you, I can tell you one thing, that each of these investors probably receive at least 10 to 15 presentations like yours every day, if not more. And these people are anyways very busy on a daily basis. They're in back-to-back meetings. They typically will get less than a minute to look at these presentations when they open their mail. And during that 1 minute, their attention is already diverted to other meetings, at the next meeting that they have to go to. But something that immediately catches attention, they will, if they are not able to look at it, they'll immediately forward it to their team and say, hey, this pitch looks good, please evaluate further. But they won't forward each and every such pitch deck to their team, right? So which means that 1 minute that you get with your pitch deck with that person you have reached out to is going to be very crucial. 1 minute. But that has happened because you sent a cold email, and chances of getting full attention during that 1 minute are very low. So therefore, what are the other methods? Typically find a reference who knows somebody in these 20 funds that you would have. I'm just giving a hypothetical number. The number could be lesser or more. Someone who is, who knows people out there, so that when they send a reference, when they connect you with those people, chances are far higher that you will get more than 1 minute of attention. And in fact, chances are very high that, depending on the relationship that this person brings, the person on the other side has an obligation to at least talk to you or to listen to you. So therefore, you do get a better attention in that sense. And the other way of reaching out always is by networking a lot more, going to conferences, attending events like these, where you actually get to connect with people, or at least get to interact with them directly. And in the process, you do get some kind of a screen time with the person, and therefore have a potential to then at least connect with the person directly. But there again, given the COVID situation, the physical world is diminishing, and therefore people are kind of connecting more and more online, and therefore you have to find creative ways to connect directly. So these are 2-3 ways to reach out to these top investors. And as I said, don't reach out to them when you need funds within the next 3 months. If I need funds in the next 12 months is when I will start this process, and start really reaching out to them, start connecting with them, start building relationships. So that's the second step overall. First one was to identify your target segment of investors. Second one is to find a way to get a warm introduction and reach out to them. Third one, which is the main topic of our whole discussion, is actually this one key document that anybody you reach out to, any investor you reach out to, is the first thing they're going to ask you. Even if you get a warm introduction, or you know the person, even if you knew this person for a long time, the first thing they're going to say, hey, send me your pitch deck. Let me take a look at it. Now, this pitch deck is a very, very important document, right? So this is a document which is going to present you in your absence. It's basically you talking to the investor without you personally being there, right? So this document has to be very crisp, to the point, identify all the dimensions of key questions that any investor would typically ask. So effectively, you should know what are the typical questions an investor would ask, right? So if you are able to answer all those questions, but very, very comprehensively, but at the same time in a crisp manner, that particular pitch deck will have a much higher chances of success. So let me give you the components of a pitch deck that basically reflect the key messaging around, or key responses to the questions that any investor would ask. There are a set of questions that you need to understand that any investor can't do without, right? So these questions are related to, number one, team. And this is not necessarily, doesn't mean that you have to present this in that order. But I'm right now talking about the key components that any investor would want to understand at the minimum. Now, team is a big area, right? From the investor's perspective. If your pitch deck is missing a slide on the team, I can assure you that the investor will lose interest there and then. Now, what should the team slide include? Now, team slide, it should include obviously the key people, the founders, the co-founders, and typically, some of the startups may also have one more slide, and they may not necessarily be the key founders, but the second layer people, just to show the depth of the team. And I think majority of the times where you are in the startup stage, the decisions are taken just based on the people. I mean, even at Series A stage, Series B stage, and many times even beyond that, it's all about team. And therefore, you get that opportunity to really talk about the team. And when you get that opportunity to talk about the team in a single slide, you have to really make an impression. And you're selling a few things. You're selling the resume of the people, which means that if people have worked with good brands, if they have good educational backgrounds, if they have done something unique in the past, which is actually worth mentioning, I think just in a few bullets, you should highlight that, or put the logos of the brands they've worked with or studied at. If there are two co-founders, have both the co-founders. If there are more than that, put that. Typically, you're more likely to get attention if you are on an average 2 to 4 co-founders. Single co-founders are typically less likely to raise funds from uh, institutional venture capital. Deals do happen, but still the chances are lesser if you're the only person who's a founder. You can have one more co-founder, and then even if the stakes are disproportionate. The second aspect of the team, and it should be typically depending on the space utilization of the slide, is the advisory board, and that talks about the quality of people you have been able to influence to actually lend their names to you, and typically do not go to an institutional investor without building an advisory board. And an advisory board should have at least 2 or 3 branded people, and it's an effort. It's an effort if you're a very early stage, but make a wish list. Do not restrict your thinking on who you should want on as an advisory board. You never know, you might get lucky. Think of the names of who's who and people who are branded, people who are known in the industry. Never assume that, why will they come on my advisory board, etc. Doesn't hurt. Just go and pitch to them why it makes sense for them to join your advisory board. But before you go to the investors, your pitch deck should actually be ready for the advisory board people. And that pitch deck should have everything that you're trying to do and why you're trying to do, and will include everything else except that it will not be asking for funding. So get an advisory board and put it as a prominent feature of your pitch deck. So from the team perspective, who's the core team, who's the advisory board, who's the second level team if you have the depth in the team. And typically an investor looks for the following in the team. Number one, they look for how committed the team is. Are you full-time? Are you part-time? Second thing they look for is the risk the team has taken. If you're working with a large corporate, you were a very senior person in one of the top Fortune 10 companies, and if you left that job to start the company, your opportunity cost is very high. So risk that you've taken is very critical. The other factor which is important is the incentive structure that you created in terms of who holds how much stake in the company, but that typically doesn't need to be presented in the first pitch deck itself. The investor shows interest, then you can always bring that up later on, but that's an important question that investors would ask. And then of course the investor would not like to know the team dynamics, how the team knows each other. Have you known each other for last 10 years, 20 years, 30 years, or you just met someone and about a week ago and then made him the co-founder? So that's a very different story, right? So your story about how you know your co-founders is very important. So that's team. The second aspect is the industry overview, the industry that you're operating in. Now, it's very important to demonstrate that you understand the industry that you're operating in and the key issues involved in that industry. How do you demonstrate that knowledge and skill? You have to make sure that you understand the size of the industry, you understand the structure of the industry, you understand the key segments of the industry, you understand the key players in the industry, you understand the buying power in the industry. Porter's 5 forces. If you haven't studied that before, just go Google it, learn Porter's 5 forces, and understand the key components of the players in the industry and the buying power. Who holds the buying power in the industry? All that is extremely important for you to demonstrate that you understand those components. And industry actually is all about, when you present the structure, you're talking about the gap that exists in that industry, and you will highlight, maybe you'll present a map of the industry and say, hey, look at the players in the industry, and this guy is operating in this segment, this guy's operating in this particular segment, which is $5 billion in size. Nobody's directly addressing it. There is nobody who's only focused on that segment. The other players who are also addressing that. I want to be the niche player and number one player in that segment. So that way, when you present the bigger picture, you're also able to demonstrate, one, of course, you're able to demonstrate your knowledge of the sector. The second is you're also able to make it very clear to the investor that where you are actually playing your game. So that's very important. It also highlights your maturity level. So do a lot of research before actually do that. Don't just, you know, pick up things from here and there and then assume that, you know, this will happen. And many times the investor might also be learning in the process. They may not necessarily, the first person you interact with, the investor team, may not necessarily understand the sector, and they may be learning from you, but they will ask all kinds of questions, and the way you answer those questions will determine your maturity level and understanding of the structure. So that's an important one. And so structure, the competition landscape within the overall structure of the industry is again extremely critical aspect, you know. And there, you know, many times, you know, investors ask this question, especially at very early stage entrepreneurs. They ask the question, who's your competition? And more often than otherwise, the response is, oh, I don't have any competition, you know. Interestingly, there's nobody else here. That is a very, very immature response, because if you believe the segment is so large, if you think the opportunity is so lucrative, if you think that this is something which is going to make you $1 billion business, and if you do think that, then it is impossible that that need has gone unaddressed. You have to understand who's addressing that need. I think the key aspect here is that you have to understand how that need is actually being addressed. Is it being addressed in a way where it is too expensive to deliver? Is it being addressed in a very inefficient manner? Are there any broken links somewhere? Is it price inefficient? Is there a better mechanism, better technology that can substantially bring down the costs? Is there something which can actually substantially change the way the customer's comforts change? So all those things have the potential to completely disrupt. So it's about disruption of the market. So you need to really, and that's also an opportunity for you to present your differentiation. So your differentiation comes from analysis of your competition. And one of the key questions that, you know, that get asked, and very important question, is that, you know, if you start putting the names of your competitors, the risk you run is that the investor may also be evaluating the entire landscape, and they may not have heard of your other competitors necessarily at that time. The moment you quote their names, you're actually also, in a way, giving away the opportunity of them now going and talking to them and evaluating them against you to invest in them. It's a likelihood, but at the same time, it's a balance you'll have to achieve. You know, so therefore, what names to quote there in the competitor slide has to be extremely thought through and understood. Because if I'm an e-commerce company which is trying to do very segmented approach to maybe fashion retailing, and you know, if I start putting competitors at the same Series A level, if I'm raising Series A capital, then I'm kind of, in a way, giving away a lot of information to the investor to also look at those people who may have skipped their minds otherwise. But if I quote companies like a Myntra or a much very large player in that market, I'm actually at least still giving the information required, but not necessarily kind of creating competition in the minds of the investors. So you need to be a little careful about that. So, but it's an important analysis to be done. You have to assume that people who are already visible, they're already known to the investor, and you have to do a lot of research and make sure that the comparative that you do is also well thought through and is a very mature analysis. So, but without that, you will come across as someone who hasn't done his homework. So that's the part of the overall industry overview. The next component of the pitch deck is the business model that you are operating in. Now, there are a few things which are important. Number one, uh, your vision. What are you eventually trying to achieve? What are you actually trying to really build? And as I said, the order can be completely based on the way you want to tell the story. And many people start with the first slide as a vision slide, which is absolutely fine. But I'm just telling you, from the perspective of making sure that you cover all these key areas. From the business model perspective, it's important to understand eventually what are you trying to achieve. Whose problem are you solving? Why are you solving that segment's problem? How you intend to solve that problem? What is your mechanism? What is your execution model around that? What is your, the go-to-market strategy around that? So there's a lot of components of the business model itself that will be very critical for you to highlight. And the better you structure it, the better you address it, the better your maturity levels will be shown, because ultimately the pitch deck is a reflection of your maturity level in terms of how mature an entrepreneur you are. And business model will also keep highlighting certain differentiation factors, because you may be differentiated based on your execution model, or your the target segment model, or your delivery model, or your something where the technology that you are building is completely new, and the product approach that you're bringing is actually bringing that differentiation. So it's very important to bring that up. And what investors look for, 2-3 things. They look for a differentiation. They look for the practical aspect of the scalability of that business model. They look for the unit economics and how it can actually be, scaled up, because if you're actually going to make profits, and the unit economics is something which is the part I would like to address later, but it starts reflecting in your business model how your unit economics works. So address all the components, and your customer segments, your go to market, your marketing approach, your product strategy, your around the product itself, all the other components of the product strategy, your pricing, your promotion strategy that you're going to use, your distribution model. So that's going to be the key areas of understanding the business model. Now then comes the key components of the financial model. The financial model, obviously, there is going to be a lot more detailing when you actually do the Excel spreadsheet, but when you actually put it in the pitch deck, it is just a key highlights from the financial model from the Excel spreadsheet reflected on the slide. And that reflects typically a few things. It reflects your revenue growth, or the key metric growth. It could be revenue, it could be NMV, net merchandise value, it could be SaaS revenues, it could be user base growth, it could be, depending on your business model, that could be different metrics. So you need to make sure that have a slide on all kinds of graphs which are critical to the business, which based on which value is going to be created in the business. And investors do look for key financial metric, how they're going to look like over a period of time, and profitability does become an important factor there. And it's very, very important to back up your assumptions, because don't assume that you can put pretty good looking graphs and got the first attention, and then when the second level discussion happens, you don't have backup to that, and then you will, whatever advantage that you would have created, you would lose that if you haven't really thought through all the assumptions and detailing around that, right? So it's extremely critical. So that particular slide is going to be extremely important. But from the first pitch deck perspective, the key things that will be important from the investor's perspective, if I'm an angel investor, I would want to see a minimum 10x in 2 to 3 years. If I am a Series A investor, I will still look for a 10x maybe in 4 years. If I'm a Series B investor, I will look at 6 to 7x in 4 years. So, the risk keeps going down as this you scale up the business, therefore the expectation returns also goes down. So therefore, how you're scaling up your business, what assumptions you're using, make sure that you're not out of the reality. You have to be in the real world. You cannot. Entrepreneurs are by nature optimistic, but try to have a realistic view rather than a super optimistic view. So present it in such a way that investor gets the impression that you're not just everything is not just pie in the sky kind of an approach. There is some realistic assumptions behind. So all your assumptions are going to get challenged. Somebody in the investor team is going to sit with you, drill down very deep into each and every number that you're projecting, each and every assumption that you're making, all your growth numbers, all your cost numbers. Make sure you have a very, very strong hold on that. So that comes to the financials. Then the next piece is about what are you looking for? What are you expecting, right? So if you're actually out there in the market to raise funds, then you can be very specific and say that, hey, I'm looking for $1 million. And I've seen this is an important point. And many times the question comes that should I put that I'm raising it at a $10 million valuation, or should I not put valuation at all? I can tell you one thing, that you may be an exceptionally good business, and your valuation may actually be worth $20 million, and you may have actually put a $10 million out there, which kind of should ideally look very attractive to the investor. But the moment you put that number there, it actually does either damage to you, or it actually does some kind of a level set or some expectation setting that ideally you don't want to bring up. That's my personal take. I mean, there are people who may have different view on it, because there are people who might say that it's better to put it there because then you save the time of the investor. They want to see what kind of stake they're going to get. Does it still fit into their criteria so they can take that decision, etc. I'm of a different view. I think you don't need to put the valuation in your slides. You just need to put the amount of funding that you need, why you need that funding, where are you going to allocate that funding, where all that money is going to go, and what that funding is going to lead to in terms of the business progress, right? So many times you put the projections, assuming that funding is going to come in. But I think one should actually try to look at both the scenarios, that even if the funding doesn't come in, I'm still going to progress. I'm going to make this kind of outcome. And if the funding comes in, then this is going to be the difference. So that is an important one from my perspective, that if I know that if I put in $1 million, this is how that $1 million is going to work in the business, and this is the outcome it's going to produce. And many times if I can put more money, I might come back and say, you've given me $1 million, outcome. What if I put in $2 million? What's going to be the outcome for that? So, or what if I'm going to put $500,000? What is the outcome of that? So you need to be flexible around that and be able to really understand the sensitivities around that. So that's the capital required and the capital used. And beyond that, I think you need to really have a contact information in the end. Who's the person to be contacted? In case of many times this pitch deck floats around, you may have sent it to person A, but the person A thinks it's not for me, but person A knows B, C, D, who may be potential investors in your company. That person will just forward the mail and say, hey, this looks interesting, why don't you take a look at it? If he just forwards it from his own email ID, now you may have sent it to me, and I may not necessarily have a relationship with you, but I like your pitch deck. Now I have forwarded to 3 other people. If it goes without contact information, these out of those 3 investors, maybe one may be very interested. And if I come back to them with a first investor saying, hey, you forwarded this to me, do you know where it came from? Chances are that the person may not even have time to look at where that email came from, or you might have even deleted that email. You never know. So you might lose that investor, which you should not. So put a slide in the end where your contact information is there. So these are the key components, and of course, depending on the business model, the product that you have. Sometimes, if you have a very technical product, the question comes that should I give the details of the technology and the product? If you have a very unique approach or strategy, many times investors ask or the entrepreneurs ask me how much information they should divulge. If people have actually done a patent, filing a patent on their model, the question is, should I give details on my product? Another question comes, I'm providing too much information, and what if investors, they keep talking to other people, they may have a portfolio company, they might just use my information to have their existing portfolio or other companies. So I don't want to divulge a lot of information. So is there a way I can, maybe I sign an NDA with the investor? I can tell you that 99% of the times, if you just reached out with your first presentation, the investor will say no. They don't want to sign. Imagine, I get almost like close to, if not more, 500, 600 deals every month just in my inbox. And if I add up all my team's inbox, there'll be numbers maybe much, much larger. The point I'm trying to make is that imagine if all 600 people who come to my inbox say that I want to sign an NDA with you. That'll be 600 NDAs for me. First of all, I don't have time. Secondly, it's just not possible for me. I mean, I just cannot sign an NDA with you and assume that that information is not publicly available, right? Or that information I already don't know. I may already have that information, and I'm so much. I'm getting information every day, and your kind of information may have come to me otherwise as well, unless you're putting something extremely confidential, which you should not in the first pitch deck. So therefore, only send out the information which you think is non-confidential, and don't expect that your investor should sign an NDA. I've seen many entrepreneurs make that mistake, that unless you sign an NDA, I'm not sending you data. Big deal. Investor does not want to care, and you're actually going to lose on it. So build your presentation in such a way that even if it is shared with other people, it's not something that anybody's going to steal anything.